Welcome, and good morning or good afternoon, depending on where you are joining us from. We're here to discuss the minerals powering the 21st century today. And while the last century was defined by oil, today's industrial revolutions, clean energy, artificial intelligence, and next-gen defense run on metals. Copper, lithium, nickel, and rare earths are more than just commodities. They're strategic enablers. And they're also bottlenecks, geopolitically, economically, and technologically. And for all their importance, the investment case isn't always clear cut. And that's what we're here to explore. I'm joined today by Adam Johnson and Nicholas Rohleder, and we're going to dive into each mineral in turn, what's driving demand, where the choke points are, and how capital markets should think about them. Let's start with copper. Copper is often referred to as the metal of electrification, essential for everything from EVs and renewable power grids to data centers and advanced defense systems. Yet we're seeing a growing disconnect between the demand projections and supply reality. So to kick us off, I'll start with you, Adam. Why is copper increasingly being discussed in the same breath as rare earths, lithium, and other designated critical minerals? And what makes it strategically different or even more urgent?
Absolutely. So copper is probably the infrastructure mineral, right? So it is fundamental to so many different aspects of what we do on a daily basis. And that goes from everything from, the cabling and the infrastructure that brings energy to our homes, the heat exchangers that keep our homes warm, the piping in our plumbing, to the semiconductors and printed circuit boards in our electronics. So it's in so many things, and it's so superfluous or so fundamental to what we're doing that it's hard to sort of say exactly where it's more difficult to find where it's not than where it is, let's say. So the fact that it's bucketed in critical minerals has been, I think, somewhat debated in the political and geopolitical circles, partly because it's always been perceived as available. So if you look at sort of the most conductive materials, you have the silver, gold, and you have copper as sort of at the top three. And, copper has always been certainly the cheapest of those, right? And so it's always been perceived as readily available. The US actually exports mined copper historically. And the the reason why it was sort of I think a debate as to whether it's critical is not related to its importance as much as its perceived historical availability. The reality is it's super important, and the challenge with it becoming so important to sort of the demand on energy as well as all of the different technologies that I mentioned is that it's actually looking to become less and less available. And as we see, and project out, we're actually seeing some deficits in copper. And that actually is not only alarming from an infrastructure and planning standpoint in terms of everything from AI to, all of the renewable energy technologies that we're looking at developing, but it's alarming in the sense that it's really the beachhead for the critical minerals and materials because it's actually publicly traded. It has, futures exchanges. It has sort of what we would call a more diversified availability of mining, and it has a durability, so it's recyclable. Whereas a lot of minerals don't have that durability. And so it's been taken for granted in some ways. But I think now that we're seeing that even copper is at risk, it's really the beachhead for most critical minerals and materials, in my view.
And I think to add to that, I mean, copper is effectively the foundation of electrification. It's used to Adam's point, power grids, EV charging, high performance defense systems, AI infrastructure, and was really designated as a critical mineral specifically by the U.S. in 2023 after the usage intensity really came to bear, right? And so thinking about that, you've got 80 to 100 kilograms per vehicle in the electric vehicle sites. That's 4 times more than a traditional ICE vehicle. You've got utility scale solar, 5.5 tons per megawatt, and AI data centers relative to traditional data centers using two to three times more copper per megawatt. And so you kind of think about this and look at the usage intensity for the future economy is increasing across all these areas that are growing rather rapidly, and you have a circumstance where the availability is declining. And we really have a circumstance where this has become more of a national security mineral than ever before across the West.
Well, okay, so on that point, do you guys perceive we're heading into a structural copper deficit? And if so, how does that reshape capital allocation decisions for institutional investors today?
I think that the evidence is that we are. I will put things in also perspective. One of the views is related to sort of current pricing and relative to historical pricing. We do hear a lot that copper is more diversified than some of the other critical minerals and materials. The challenge, if you sort of look at the numbers, right in front of us, is that it's actually not quite as diversified as you may think, right? So OPEC, back in the 70s was call it mid-30s% market share, and China by itself right now is mid-40s in copper. So we're seeing, a circumstance where our energy future is going to be highly dependent on copper, as well as our technology future, which is everything from, electric vehicles to the, computers that are powering our conversation right now, to sort of all of the different high-tech defense systems and everything else. Copper is going to be fundamental to all of that. And if we are in a situation where, we have this sort of single point of failure in the supply chain, or at least from a market share perspective, outsized influence from, in any individual country or, sphere of influence, we have a supply demand challenge given that incredible demand dependency.
And to that, it's quite interesting when you think about this as well. You look at there's a couple of things in play on this matter as well. Copper is suffering from one of the classic issues that faces most minerals over time, and that there are less high quality discoveries occurring in more volatile jurisdictions. And so you look at ore grade decline. So a century ago we're at roughly 1.6%. Now we're down to less than 0.6%. And you look at increasing concentration areas, Chile, Peru, you have China in the value chain there. And as you have, from an investor perspective, thinking about this, as you have more demand, you also have, forgetting the early 2000s and early 2010s gave us the China commodity super cycle. CapEx, the levels for copper are still 50% roughly below 2012 levels. And so there's a lot of room to run there for expansion. And I think that from our view, we see the persistent premium pricing occurring in the market over this period where demand is strong. This circumstance of declining quality, the less volume of reserves, more volatile jurisdictions. I think that what you're going to see there is an increased preference for the expansion of brownfield projects in some of these jurisdictions that are offering state-related support or alongside the friendshoring theme specifically.
Well, yeah, picking up on that idea of perhaps geopolitical risk embedded in the copper supply, do you think those risks are already priced in?
I think that, I try to avoid prognosticating about price, but I think that from my standpoint, it's probably very difficult to price in the long-term importance of this mineral or in regard to our future economy, right? So just even going back to the statement I made before about OPEC, I don't remember what oil prices were in the 70s, but it's probably different than it is today. And those probably seemed high back then. So everything is relative.
And I think that, I think this is underappreciated to a degree because, you have, you look at Latin America mines, the just over 40% of global copper. China refines 40 to 40% of global copper concentrate. And the U.S. has some presence in that value chain, but it's limited. And I think that, the two aforementioned regions, have had a propensity in past administrations and years for resource nationalism. And I think you've seen that, across the board in the last 10, 15 years. And we had one thing that I think with that is an underappreciated risk is that, the last 10 to 15 years post-financial crisis, we've had a huge expansion in global debt. And we've had a very strong dollar, which has not been kind to a lot of these countries where there are significant reserves. And so you have a situation there where you have an unstable economy, a large debt burden, and you have a circumstance where they really have to turn to the resource endowment to get themselves out of that hump. And so I think that, especially with the current set of circumstances with the tariffs and different things going on, I think that the degree to which that is used as a tool for economic rebalancing is underappreciated broadly.
All right, turning to the demand drivers for copper, Adam, you touched on a number of them, but what do you think is most underestimated in the copper thesis right now? Is it the grid upgrades that are coming, the AI data centers, the EV infrastructure? Where is that demand going to come from?
Yeah, so as I sit here in Washington, D.C. today, I think one of the biggest mistakes is that we tend to overemphasize sort of the Western aspects of this. When you think of copper as an infrastructure mineral, and you think of the global demand for infrastructure upgrades, I think that that's the biggest issue. So we often think of, okay, AI data centers in the US, we need 100 megawatts here, 100 megawatts there, a gigawatt there. Well, the other question that always sort of sticks out in my mind is, well, what are they doing everywhere else in the world that also needs copper? And I don't think that that's fully appreciated in most of the data that I see.
That's a good point.
It's funny, people forget that in the US and in Europe, you kind of have three different things going on here. The US and Europe, the European grid was rebuilt after the Second World War. The U.S. expanded around the Depression and the Second World War period through the public works programs. And you have the countries such as India, China, that are on the upswing from an economic growth perspective, that they are aggressively building out their grids to accommodate the future economy here. And then we have now, physical AI infrastructure, such as hyperscale data centers, as previously mentioned, are using a lot of copper. And so, you have this situation here where the rebuilding and the greenfielding of the appropriate level of transmission capacity to support this is all occurring at the same time. And I think that those things are not necessarily linked together. And I think that people really do forget how old the transmission grid is in the United States, in Europe, in the Western world, and how that actually came to bear years ago.
So to wrap up on copper, what are the most investable parts of the copper supply chain right now? Is it processing, mining, recycling? Where do you think that investable opportunity sits?
I would say, investing is obviously a sort of function of time and sort of background and competence. The nice part about copper is if you have an understanding of mining, there's investable opportunities there. And if you have an understanding of trading and futures, and there's an investable opportunity there. If you have an understanding of sort of the midstreams, say like advanced implementations like PCAM and batteries, like there's investable opportunities there. You've got to be looking at the hold period, all of that, and how you're thinking about your investing structure. But I do think that the nice part about copper is that if you have a long-term view, it's probably hard to go wrong generally.
there's in that area, there's sufficient brownfield expansion opportunities that offer a reasonable path to cash flow. You have a liquid commodity that's tradable, and you have the circumstance with the permitting issue, it's roughly 12 to 15 years for reference in OECD countries, is less of a problem. So that's one area. There are true upstream the opportunities available and on offer in multiple circumstances. I think the other thing that is kind of interesting, if you look at sort of the midstream 1.0, relatively simple business, commodity in, commodity out, commodity converter kind of business. The other thing that I think is rather interesting is, presently the 17% of the copper is actually supplied vis-a-vis recycling, and it's expected to increase. And so I think increasingly this midstream 2.0 of deriving a critical mineral such as copper from waste, which is something we'll talk about a lot in this presentation, is increasingly an opportunity set where you have proven or near proven technology, attractive contracting structures on the receipt of the waste and the sale of the end critical mineral product, and increasing preference from in-market users to transact with supply that has been secured in this fashion.
Okay, terrific. Let's turn our attention to lithium. Nicholas, you and I have covered lithium an awful lot, but I'd like to pick it up again today. It's been called the white gold of the energy transition, but after a meteoric rise in price in 2022, we've seen a really sharp reversal. Spot prices are down over 80% from the peak, and yet global EV penetration continues to accelerate, and governments from Washington to Beijing are racing to secure supply. So given the price collapse over the last 12 to 18 months, where are we really in the lithium cycle right now? And is this a healthy correction or a signal that expectations were overblown?
Sure. I don't think that I would say expectations were overblown. I think that, I always go back to timing, right? Like if your expectations are that, the US or EU is going to all of a sudden switch to 100% EVs, then you're probably disappointed. The reality of lithium is more fundamental than that, though. The reality of lithium is predominantly used for energy storage. It has other applications in ceramics and using its heat resistance for, lubricants, things like this. But it's almost entirely like energy storage from a market standpoint. It has really important lightweighting capabilities from a defense and aerospace. But if you think of the importance of energy storage and mobile energy storage, as well as grid energy storage, that is not going to change, right? Like 100 years from now, energy storage is going to be vastly more important than it is today by any spectrum of sort of like, an optimistic future of the world, right? So if we think about it like that, I think what we're also realizing now, and lithium is different than copper. So lithium is predominantly related to mobile energy storage in sort of a lot of its applications, right? So your computers, electric vehicles, UAVs or what have you. So, there is grid energy storage aspects of it, but it's different than copper, which is, much more infrastructure based. And with lithium, you're also baking in downstream products. When you're talking about China controlling almost 60% of the refining, the ability to sort of play a role in sort of the end commodity price of that to the benefit of downstream productization is a huge factor that I think has been underappreciated in sort of the current sort of pricing cycle. The reality is over a longer period of time that influence is going to become much more muted just because of the ultimate demand drivers of lithium. And so I think you are seeing in the near term and sort of in the short term more volatility in lithium than some of the others. But I do think the reality is actually that creates the potential now for actually likely greater outsized opportunity, given sort of the multi-decade long demand trajectory of lithium. And so I think that's also can be seen as sort of I'm always interested when, we talk about long-term demand cycles, and all I hear about is short-term pricing. And I think lithium is actually probably more dislocated in that regard, and probably a bigger opportunity in that regard than the others.
And this is pretty much it. If you look at how commodity markets have worked historically, this is a relatively standard cyclical correction inside kind of a structural bull market over a long term. And I think that obviously you have an 80+% drawdown in the commodity over a 2-year period, but you have, as Adam mentioned, a long term demand thesis that is still relatively intact. And I think that this has happened throughout history with every single commodity that is critical to or touches modern life. The biggest thing there is to really think about and unpack some of these long-term demand trends. Right now, obviously, there's a lot of noise coming from the regulatory situation in the U.S., but not that much has changed globally. And I think in the U.S., it's 100 days that I don't think consumer preferences have changed really that much. And so you have pretty strong long-term demand case that is in play here.
I'll also add, I mean, there's a lot of noise around these topics, but lithium is, from an attribute standpoint, when you get to the sort of fundamentals, has the highest energy density of the minerals, right? It has the ability to store the most. And you can talk about different battery chemistries and different solutions for storing energy, mostly because of inability to sort of source lithium at the levels that people want, ironically, given the price dynamics. But the reality comes down to, over a long period of time, will the market want the stuff that stores the energy the most efficiently, or do they want the stuff that stores it less efficiently? And I think in the end, the market will dictate that most efficient will be the winner, and that's going to be lithium.
Well, and I think that makes a lot of sense. Thinking from an investor perspective, how do investors reconcile the long-term structural demand with the short-term volatility in pricing, especially that we've seen in the last couple of years? And does this represent a tactical entry point or warning sign?
The way I would look at it, obviously no advice given, but the way I would look at it is from a cost basis standpoint, right? So the way you look at minerals generally is you start to say, okay, what is the cost basis for the lowest cost producers? And we're sort of cutting to the bone at this point on the lowest cost producers, if you get the data on globally. And so I would say that if you have a fundamental material that is required for future energy storage, which is fundamental to our economy, and you have the low cost basis producers, being the only ones hanging in there right now, it starts to look like, a very compelling opportunity over if you have a reasonable hold period. Obviously, there's still volatility, right? It could shake here or shake there next month or next month, but if you're going to hold over a longer period of time, it starts to look like it makes a lot of sense.
And in any kind of commodity, the investing circumstance, to Adam's point, you just have to be mindful of the lowest rung of the cost curve and work up from there. So think about the absolute downside case scenario, which we've just dealt with over the last couple of years here, and think about the statistics here. Lithium projects take 7 to 10 years to come online. We need 70 to 80 of them by 2035. And we're at the lower rung of the cost curve right now, and working up from there. And so I think that really being meticulous around using these drawdowns as entry points into low cost producers, converters, downstream integrated players. Like that's how you have to really think about this. With really minding precisely where they sit on that cost curve, and how that will impact each given company that you're contemplating investment in.
Right. And so picking up from there, how do you assess the geopolitical risk embedded in lithium today, especially following China's recent export controls and really their dominance in processing lithium?
Um, I try to make things like that as simple as possible. We can get caught into a lot of the noise of, this administration or that administration or this, policy or that policy. If we sort of look at it as, you know, optimistic, the Western world is going to survive and hold our own over the next 20, 30, 50 years. We're going to have to figure this out. And if we're going to invest into that, then I think, relatively investing into this versus some other areas is going to give you a springboard towards, greater normalization over a long period of time.
And I think that one thing that's critical to think about there is, China controls 75% of the chemical refining, the 70% of battery capacity, 80% of processing capacity for cathode anode. And as mentioned, there's been some discussion of the export restrictions, and I think that the the challenge there from an investor perspective is really looking at how that level of concentration translates into price manipulation in the jurisdictions that you're investing into. What are the government related protections around that, if any, and how does that relate to the lowest marginal cost producer, which in this space right now is sitting around 20,000 from a price perspective. And so just kind of translating all those things together is how you really form a thesis around this, with specific the focus on how that dominance translates into price manipulation.
Okay. Thanks, guys. In terms of real technology risk to lithium's dominance in the battery ecosystem, is that accurate, or are these alternatives still too far off to matter in an investment horizon?
I always go back to the fundamentals, like I was saying earlier. When you know, absent anything else, would you want to use the one that stores energy most efficiently or not? And that's always going to inure to the benefit of the most efficient solution, and that's going to be lithium. In some cases, there are circumstances where other energy storage solutions are sufficient, right? And those will, tend to go to alternatives if lithium or other aspects of that chemistry are going to be difficult to source. And I think that that's important and that should happen. But there will always be a place for lithium in energy storage, and as far as I understand, in the mineral ecosystem.
To that the angle there, I don't believe that there's any the substitution risk that's coming this decade. Maybe in the medium term, being 2030 plus, but in the very very near term, where the most critical the investment needs to be made, this is not a risk.
Okay. What part of the lithium value chain, the raw material conversion, battery integration, do you guys think offers the best risk-adjusted return today?
I think that from my standpoint, you would look at the midstream sort of refining aspect of lithium. We are seeing, Australia is a great miner of lithium. They are sending most of that to China for processing. We are seeing, a lot of opportunity for Western refining solutions. The US actually has significant brine resources. So the ability to convert that and then refine that, I think, is a big opportunity. Um, there's, the real question is going to how do you get to a refined lithium product in the Western world from the existing resources that are pretty well known.
And as you saw with the run up in price of lithium, there's clearly a willingness to invest in the upstream part of the value chain. I think that in going back to where China has the most control, and where the Western government perspective is going to be on top of that, is that unseating the Chinese the control of the midstream, the processing and refining part of the value chain, to Adam's point, is going to be where the opportunity is, and where that capital market and entrepreneurial ecosystem is in its nascency, and really set up for nice growth as this price comes back here.
All right, one final question before we move on. I want to close with direct lithium extraction. Is it a game changer or is it overhyped? If it does work, what does it mean for the supply, pricing, and capital intensity of lithium?
I think that direct lithium extraction in its current iteration has a lot to be proven, right? That being said, whether it's, a specific technology provider that exists today or a coming specific technology provider that will come tomorrow, it will be solved. Most of the challenges, I mentioned US brines, are going to be related to impurities and these types of things to get it to the most economic extraction of lithium, which also can be seen as the most useful or the most optimized use of all of the minerals that are sort of contained in that brine, meaning the byproducts as well. I think that is still being optimized, but a lot of very smart people are working on this. And I do believe that there's going to be really strong pathways forward on that. Like I said, whether it's in the technologies that sort of exist in their current iteration or are going to be refined and developed over the next coming years.
I think that on the DLE side, to Adam's point, there's a lot that has to be proven on the technology side. But you consider some of the benefits as this technology starts to get proved out. This is similar to this kind of waste to value theme that we're discussing. But there's obviously a cost reduction benefit, a water use, the reduction benefit, which, especially given Latin America as one of the primary jurisdictions for mining here, is very important. And so I think to the point of how do you think about this from an investment perspective? There is significant technology risk associated with this at this point, but the benefit there is that this is really being styled as distributed infrastructure, serving the critical mineral space to a certain degree. Which if you think about how those business models have worked in the past and evolved here, like as this technology gets proven, the business case, I think, will become much more straightforward as a distributed infrastructure solution to garner access to critical minerals.
Okay, thank you. Let's turn our attention to nickel. Nickel is one of the few metals that straddles two industrial revolutions. Impressive. Been around a while. It's a legacy steel input and a future-facing battery metal. Yet in the past year, we've seen prices slump more than 40%, driven largely by a flood of supply from Indonesia's high-pressured acid leach operations. And while Western nations are labeling a critical mineral, investors are stepping back. So let's start with this question. Why is nickel, despite being labeled critical, experiencing such a sharp market correction? And does this price action reflect real fundamentals or a structural overreaction?
Again, I think it's sort of, throwing out the academic answer, it sort of depends. If you're, sort of investing for quarter by quarter, you're going to be a lot more sensitive to sort of the swings, right? And, we've seen everything from, the initiation of the war in Ukraine affect prices in nickel to, individual sort of trading firms, located in China affect prices of nickel. And then we've seen investment into Indonesia from China affect, sort of the availability of nickel. And I think that the reality over a long period of time is, again, nickel is going to be one of those materials, and minerals that sort of survives in terms of its importance for everything from corrosion resistance to durability to its ability to, enhance the performance of batteries. It's just one of those metals that just sort of has that capability to impact so many things that, we do in our lives. And that way, it's almost like an in between lithium and copper, right? So you're going to see it in so many things similar to copper. but it also plays in sort of the battery and storage space like lithium. From an availability standpoint, we are seeing declines in ore grades. We are seeing, some of the same issues that are going on in copper happen in nickel. We have seen buildup in refining and sort of mining operations in Indonesia that have sort of countered that in the short term. So we likely have a buildup of availability. We also likely have a buildup of Western brownfield mines that, could come online if sort of, the prices rebounded in any meaningful way. And so I don't know what I would prognosticate from a price standpoint. It's somewhat structurally different than the other two, in the sense that, as you mentioned, it's been around. There is infrastructure. A lot of the new infrastructure in Indonesia is what's really affecting prices. So there actually has been fundamentally changes in sort of the supply availability. But over a long period of time, it's going to end up being very, very important. So I would say one of the more difficult to sort of forecast in terms of what I would say relative to the two we've talked about already.
And yeah, Indonesia is producing in over 50% of global nickel now, and I think that you look at nickel as the sleepy industrial input that now has a host of new demand centers that are driving demand. And the issue there is like some of the historical uses such as steel. Looking at Indonesia, the predominant producer here. The companies investing in Indonesia and driving this expansion of supply leading to surplus. It's driven by the Chinese, right? And that's also being done at a time where there's the investment occurring as some of the traditional industries that support the nickel markets, such as steel, going through severe crises, which you see a couple months ago. 1% of global blast furnaces, turning profitability, and so there's that dynamic there that you have surplus, decreasing demand in the main historical market that has supported the nickel industry, and then you have the relative uncertainty, but still a long-term demand thesis that's in play for battery grade nickel, and so there's this issue here where it's you've got a near-term crisis, but the long-term circumstances that are attractive from a demand perspective, and just parsing through that, I think that what we really need to see here over the next few years on the nickel front is the steel industry and the use of this and its corollary start to stabilize, so you can get a better picture of from a supply perspective, what is serving the battery market, how this is being brought online, and really what the industries are driving the cadence of nickel investment that are really ex-China, and not pushing this, as China has done a lot of areas, structural oversupply in commodity markets from raw materials all the way down to hardware.
Okay, thank you. And so, threading that through, how should investors assess the risks and the opportunities of Indonesia's dominance in the nickel market? And is this the new Saudi Arabia of battery metals, or is that a house of cards?
Definitely don't believe that Indonesia is a house of cards. I think that they have a very big backer and very savvy global approach to how they are, sort of impacting the market. And so I would say that this is, a structural change, Indonesia's emergence into the nickel market in the way that it has in the last few years. I think that will have to be factored in going forward. I do believe that there are counter Indonesia situations coming on, and that's where you get into like the geopolitics of it all, and sort of the dual sourcing and sort of localization of sourcing and all of these things. I think that my sense is, from like a pure market standpoint, the Indonesia reality is probably more permanent than tariffs and sort of localized sourcing, because in the end, sort of price wins. And I do think that that's going to open a very challenging, I think, sort of competitive environment for nickel going forward. But I do think that, again, it's really a question of demand versus supply. And I do think that you still, over a long enough period of time, depending on how you're looking at the space, see this as sort of an opportunity going forward over the sort of coming decades.
Indonesia is an interesting jurisdiction. It's historically played host to a lot of commodity cyclical companies successfully. And I think if you look at the nickel circumstances in particular, there's been relatively aggressive investment. Granted, it's effectively a Chinese proxy, but the investment has occurred, and I think that you look at the steps they've taken. The administration they have presently is seeking to diversify their sources of capital. They've set up a sovereign wealth fund committed to a high level of transparency, added Americans such as Ray Dalio and Jeffrey Sachs to the advisory board of that sovereign wealth fund. And I think that they're taking the progressive steps to become friendly to a variety of jurisdictions and try to make that diversification push. The challenges and drawbacks there that really are to watch from an investor perspective is, there's different perceptions depending upon your investment program around ESG risk. But Indonesia does derive its power from coal. They have historically placed export bans on raw ore, and there have been challenges in the past with the observance and adherence to the rule of law. And so, I think that the very constructive steps are being taken to get to a point where investment can flow through Indonesia. There can be joint ventures with the local companies for Western groups to garner supply of nickel in a secure fashion. But again, a couple of those things to watch there that have been a challenge historically in other commodity verticals that Indonesia has played host to historically.
Right. So, Tesla, Ford, and others have moved to diversify battery chemistries, sometimes shifting away from nickel-intensive designs like NCM and LFP for cost reasons. What's the real long-term outlook for nickel demand in batteries? And are we at risk of demand falling short of expectations?
I think that unlike lithium, I would say that nickel, I think, has a lot more variability relative to the chemistry. And I think that there are, a wider variety of, battery chemistries that, could include or exclude nickel without, too much stress. I think that being said, nickel is, again, sort of fundamental to everything from steel to catalysts to batteries to a bunch of stuff. And so I think that if you over-index too much on hope in a model for batteries, I don't think that would be advisable.
The concern that's emerged is, China is the world's largest EV market presently, and the lithium iron phosphate, the chemistry dominates the roughly 60% of that market. And so a lot of people look at that and say, okay, well, that's going to be exported into other markets as EV demand picks up, which has not really been the case. As was mentioned, the nickel-rich chemistries are still favored for Western markets, long-range electric vehicles, and aviation and defense electrification, as an example. And the degree to which the LFP in China will dilute total nickel intensity globally, I think is overblown. That will happen to a certain degree, but very much presently the long-term nickel demand in the areas that were mentioned is intact and going to be in place for the foreseeable future.
So, unlike lithium or copper, nickel has seen relatively little excitement from institutional capital in recent months, despite its critical designation. Is nickel misunderstood or just too complex for most investors? And where should allocators be looking today, upstream, midstream, or even recycling?
Nickel will have its day, right? If everyone's looking in one direction, it's probably a good idea to look in the other direction, is what I get advice from most of the successful investors that I've spoken with. And so I do think nickel is going to be an important one to watch. As Nick mentioned, sort of the fundamentals in the battery are going to continue to include nickel. The other thing, again, nickel is such a versatile and important mineral in every alloy that we use in some ways. And so I think that I would continue to pay attention to it. But again, it's going to depend on sort of how you look at the time period and the time horizon of your views.
Presently, nickel in Indonesia, as we've kind of discussed, is a China proxy, right? So that's one thing, and I think that that has also coincided with a rather complex supply chain, some ESG related issues, and the issue there that as that proxy relationship, that China does have the ability to manipulate prices if it so does choose to do so, and I think that that gives way to a situation here where you also have consider the regulatory circumstances, as we kind of talked about, where Indonesia is trying to harvest more of that value chain outside of the reserve domestically. So that really leads you to kind of two areas that are increasingly interesting. One being the refining the area of the value chain in friendly jurisdictions, perhaps in the Western world, and then also recycling. It's projected that 10 to 15% of supply is going to come from recycling by 2035 area, and so I think that is something that is presently structurally underinvested, that has a lot of room to grow, and there are plenty of areas where there are entrepreneurs, innovators, and investment opportunities on offer that specifically in that recycling area, back to that theme of waste to value, I think will be increasingly important given the situation with China and Indonesia and some of the goals that we have in the Western world to reach self-sufficiency, where for example, the U.S. Auto OEM base has a preference for nickel-based chemistries, and so I think that recycling value chain is really something that's overlooked, underinvested, and there's interesting opportunities emerging there.
Terrific. Guys, we've got less than 10 minutes left, and I really want to cover rare earth elements. These are indispensable for permanent magnets, and they power everything from offshore wind turbines to F-35 fighter jets. So yet, despite the growing demand and elevated national security concerns, rare earth elements remain among the most opaque and underinvested corners of the critical mineral world. So to kick things off, why do rare earths continue to be one of the most strategically important but commercially underdeveloped critical minerals? And what's holding the sector back from broader institutional investment?
Rare earth is, slightly different than the other minerals in the sense that rare earths consists of 15 lanthanide minerals, and then potentially a couple other ones, scandium and yttrium, if you include those. So 17 minerals. So it's different in the sense that you end up with more complex refining required. Most of the value simultaneously, which is somewhat interestingly indifferent than like copper and nickel particularly, is driven by one use case, right? So permanent magnets is the predominant economic driver of rare earths. It's important, though, in a lot of applications outside of permanent magnets. And permanent magnets are important in a lot of things, everything from, electronics, our, watches and our earbuds and our, computers and our iPhones and everything else, to, as you mentioned, sort of like the defense applications and electric vehicles and motors. It's very opaque in the sense that most of the data resides in China. So that's one. I think we're seeing like sort of refining up around 80+%. I think, the data here says 77. I think it's probably more, is done in China or within China's sphere of influence. And then, going a step further in terms of, rare earth metal and magnet, you end up even greater, sort of plus 90% occurring in China. And so part of it is just how do you build a model around, the investability of it? And I think that that's where investors really start to get, stuck. And so we have seen bespoke or sort of, smaller scale operations in the West. But I do believe that what will be required is sort of a view on scale. We've seen significant investment in mining and commitments to mining. And so over the next, call it 2 to 3 years, we're likely going to see a significant amount of availability of mined rare earth outside of China. And so that may unlock some of the downstream investments. Or it may just put those miners in a difficult situation where they're stuck with China as a buyer of last resort, which I think may be challenging given some of the federal funding, from Australia, from Japan, and from the United States that has gone into the mining, that may put the taxpayers of those countries in a situation where they're essentially subsidizing China's downstream rare earth businesses. So I think that there's a lot of complexity to rare earths that doesn't necessarily exist in those other markets. Additionally, rare earth is not traded in a Western exchange, right? So you can't go and buy neodymium or dysprosium futures. The prices are set within China currently in the market. So you're in an environment where prices are set by your largest competitors. And so that's a little bit different than, say, like copper or nickel, certainly, or even lithium, which is sort of a developing, I think, developing its liquidity outside of China.
Yeah, I think that to sum that's extremely well said. And I think to sum that up, you've got a high strategic value commodity, and it coinciding with low commercial visibility on the pricing and offtake side, which generally speaking, that that combination generally leads to hesitation on behalf of institutional investors focused on this sector. Just the main thing being the price, opaque nature of the pricing structure.
Right, so we've got time for one more question. Can Western-led supply chains like those in Australia, Canada, and the US realistically compete on cost and scale, or is this a subsidy-driven strategy the only viable path?
I'm a firm believer that Western producers can compete on price and scale. I've seen it. I think one of the very, very important things is, we need to sort of break through on scale and have sort of multiple turns at the pricing cycle. Because we've seen, any individual business may not survive, but the industry will. And over time, the cost of capital will continue to come down. And that will create opportunities for competition on price. That, to Nick's point, and I think to your question, to the heart of your question, does create, risk from an idiosyncratic investor standpoint on whether they're investing in the right one, who will win or who will survive those cycles or not. But I do think the industry itself over time, to the heart of your question, will be competitive.
And looking at other areas that touch climate, new industries, just looking at the history of subsidies in the commodity world as well. There's a lot of discussion of this, like what's this bridge to bankability, and how does this kind of work? And I think that looking at the rare earth value chain in particular, its criticality, its irreplaceability, and a lot of the defense, energy transition, AI, and just basic human life, the convenience, the applications. I think that government intervention to a certain degree, not on a permanent basis, but in the immediate term, is going to serve to a certain degree with things like creation of stockpile, offtake, and demand side related interventions as that bridge to bankability and to that comfortability of institutional investors participating more holistically in that value chain.
Adam Johnson, Nicholas Rohleder, thank you so much for joining us today. This was a fascinating discussion, and I loved it because I came away, I learned a lot, but I really enjoyed it and appreciate you leaning in to share your insights. Thank you.
Thank you for having me, Liz.
Thank you.